Good morning. My name is Denise Weirs. I'm the Director of the Corporate Finance Division at the Alberta Securities Commission. Thank you for joining us for our 2024 Corporate Disclosure Information Session. Today's webinar and the corporate disclosure report that was published on December 6th are really the culmination of the efforts of our corporate disclosure and financial analysis department in the division. And that is a group comprised principally of accountants, and they're responsible for reviewing the majority of our disclosure filed with us in Alberta, whether that's prospectuses, the various continuous disclosure documents, or voluntary disclosures. And they prepare that report and today's webinar in order to outline areas where they think issuers may be having some challenges with the disclosure, with a view of providing some assistance and ultimately to ensure we have high quality disclosure in the Alberta capital market. So we hope that it will be of assistance to you. So today you're going to hear from 4 members of that team, as well as Tim Robson, our manager of our legal department, on some policy developments. Consistent with the approach we took last year, we're continuing with the webinar format, which seemed to be sort of the preferred format by most participants. And we split the session. So today's session will focus on general corporate disclosure that would be applicable to all reporting issuers. And then on February 1st, we will have another webinar that focuses on reserves and resources disclosure. That really is the effort of our energy group. As well, if you're interested, that team for that webinar, they've provided some guidance on renewable electricity projects, the types of disclosures that would be helpful there. And they monitor for sustainability related disclosure by energy sector issuers, as well as financing activity. And so they'll be sharing some of that with you. So if you're interested, the report's available on our website, and that session, as mentioned, is on February 1st. Before we begin, we did want to acknowledge the lands on which we are located. The Alberta Securities Commission is physically located in Calgary, but of course we serve the capital market across the province. And so I'd like to acknowledge that what we call Alberta is the traditional and ancestral territory of many peoples, presently subject to Treaty 6, 7, and 8, namely the Blackfoot Confederacy, including the Kainai, the Piikani, and Siksika, as well the Cree, the Dene, the Saulteaux, the Nakota Sioux, the Stoney Nakoda, and the Tsuut'ina Nation, as well as the Métis people of Alberta. We acknowledge the many First Nations, Métis and Inuit, who lived and cared for the land and have done so for generations, and are grateful for the traditional knowledge. We have benefited from knowledge and the perspectives shared with us on various fronts in our rulemaking and other efforts, and in particular feedback in respect of our diversity initiative, our climate-related disclosure project, and our efforts to update the disclosure around mineral projects. I'm going to turn it over now to Nicole Law. Nicole is one of the senior securities analysts in our corporate disclosure and financial analysis department, and she has been instrumental once again in ensuring that we have got the report published and in organizing this webinar. So I want to thank her and all of the team for their efforts in doing that. And I will come back as we get to the Q&A session at the end of today's event. So with that, I turn it over to you, Nicole.
Thanks, Denise, and good morning, everyone. My name is Nicole Law, and I'm joined by my colleagues Chelsea Halsworth, Jennifer Pearson, and Roger Prasad. We are members of the Corporate Disclosure and Financial Analysis team who conducts the reviews as part of the Alberta Securities Commission Disclosure Review Program. Today's discussion is intended to highlight the importance of continuous disclosure documents, recognize the significance of the MD&A, and identify some common deficiencies. Provide insights into other key disclosures, pointing out some key timing requirements, and provide an update on recent developments in our regulatory update. Before we get started, if you could take a note of the following disclaimers. If you have any questions during the presentation, please use the Q&A button that is located at the bottom of the screen. We will be answering these questions at the end of the discussion. We will attempt to answer as many questions as possible, but if we are unable to get to your question, please provide your email address when submitting your question so we can get back to you, or you can reach out to us after the presentation. Our contact information will be provided at the end. This session is eligible for Certified Professional Development, also referred to as CPD hours. During the session, 2 codes will be displayed. To receive a CPD certificate for this session, you must enter the 2 codes displayed in the survey at the end of the presentation. So please ensure to write down the codes as they are shown. The first topic we will be covering today is the importance of continuous disclosure documents and the obligations that reporting issuers have in relation to filing them. Under Canadian securities legislation, reporting issuers must file certain prescribed continuous disclosures about their business activities and financial results on a timely basis. Most of the continuous disclosure requirements fall under these securities rules and regulations. The purpose of these requirements is to ensure that investors receive a high level of continuous disclosure across Canada to make informed investment decisions. But it is ultimately the reporting issuer's responsibility to ensure compliance with applicable securities legislation. When talking about continuous disclosure documents, often the first documents that come to mind are the financial statements and MD&A, but there are many other types of continuous disclosure documents. On an annual basis, reporting issuers are required to file audited annual financial statements, annual MD&A, annual certificates, information circular, and if applicable, the annual information form. Whereas on a quarterly basis, reporting issuers are only required to file interim financial statements, interim MD&A, and interim certificates. In addition to these standard filings, there are other regulatory requirements that must be considered. These other requirements relate to disclosures that may be included in the standard filings or are filed as a standalone document as a result of an event or transaction occurring. Please note that this is not an exhaustive list, and there are other types of continuous disclosure documents required that are not listed here. I'm not going to go into detail on the requirements for these filings, as Chelsea and Jennifer will go into a deeper dive into these other types of continuous disclosures required later in the presentation. There are also industry-specific disclosures required for particular industries. For example, reporting issuers with oil and gas activities are required to file disclosures in accordance with National Instrument 51-101, which includes filing a statement of the reserves data and other information specified in Form 51-101-F1, a report of the Independent Qualified Reserves Evaluator or Auditor as specified in 51-101-F2, a report of management and directors in accordance with Form 51-101-F3, a notice of filing as set out in Form 51-101-F4 at the end of the reporting issuer's financial year, and when applicable, a notice of ceasing to engage in oil and gas activities. If you are interested in learning more about the reporting requirements for oil and gas activities under National Instrument 51-101, the ASC is hosting an Energy Matters information session on February 1st. Registration details can be found on the ASC's website. There are 2 types of reporting issuers in Canada, venture and non-venture. A venture issuer is defined as a reporting issuer that does not have any of its securities listed or quoted on any of the Toronto Stock Exchange, a Quitus NEO exchange, a United States marketplace, or a marketplace outside of Canada and the United States, other than the alternative investment market or the London Stock Exchange or the Plus markets. A frequently asked question we receive is if a reporting issuer with securities listed on the TSX Venture Exchange and quoted on the over-the-counter market in the United States is considered a venture issuer. As the marketplaces for which the issuer is listed or quoted are not identified in the definition, the issuer would be considered a venture issuer. The CSA's distinction of venture and non-venture issuers is an important factor in supporting Canada's public venture capital market and facilitating the ability of early-stage companies to access Canadian capital markets. As such, reporting requirements are less prescriptive for venture issuers, allowing management to focus on the growth of their business. A key difference between venture and non-venture issuers is that venture issuers are not required to file an annual information form and can file a basic certificate under National Instrument 52-109. But the most significant difference between a venture and non-venture issuer is that venture issuers generally have longer filing deadlines. For example, the filing deadline for annual financial statements for a non-venture issuer is 90 days after year end, whereas it is 120 days after year end for a venture issuer. It is fundamental that everyone investing in securities have equal access to information that may affect their investment decisions. As such, a reporting issuer that fails to file a continuous disclosure document prescribed by securities legislation will generally be noted in default. The ASC and other CSA regulators will then generally respond to a specified default in one of two ways: by issuing a management cease trade order if the issuer applies under National Policy 12203 and demonstrates that it is able to comply with that policy, or by issuing a failure to file a cease trade order. While we recognize that issuers may sometimes face difficulties in complying with filing deadlines due to the circumstances beyond their control, we do not believe it is appropriate to change a filing deadline simply to allow an issuer to avoid being in default. The ASC and other CSA regulators will consider each issuer's circumstances in deciding what action, if any, is appropriate to respond to a default. Once an issuer is in default, a failure to file a cease trade order may be issued by the CSA regulator at any time. I will be back later in today's session to discuss the revocation of failure to file a cease trade order. I will now pass it over to Jennifer to talk about the importance of the MD&A and some common deficiencies. Jennifer?
Hi, everyone. As Nicole mentioned, I'm going to talk about the management discussion and analysis, or MD&A, and common issues we see with regards to it in our continuous disclosure reviews. As outlined in Form 51-102-F1, the MD&A should be written from the perspective of management and provide a balanced discussion, openly reporting both positive and negative information. It should cover three specific areas. It should analyze the performance of an issuer over the period covered, supplementing and complementing the financial statements, describe the issuer's future prospects and plans, expected trends and risks of the business, and explain an issuer's financial condition. However, in our reviews, staff have noted a deficiency in the depth of analysis provided in all three of these areas. I'll provide a brief discussion of some of the problems that we're seeing in each of these areas and outline staff's expectations for the disclosure. Firstly, analysis of performance. It's important that management include a clear description of an issuer's business and provide a detailed analysis of the issuer's performance for the period covered so investors can understand why and how results were achieved. A problem that we note regarding issuers that have started a new project or expanded into a new business or geographic location is that the disclosure does not always adequately describe the project or new business. Consequently, readers are unable to understand the significance of the project or venture and its impact on the issuer. To ensure that readers can understand an issuer's new enterprise and the issuer's performance in it, management should provide a clear explanation of the new products or services, associated revenue streams and drivers of revenue, and related costs in the MD&A. Another issue we consistently identify in our reviews is a failure to adequately explain why variances from financial statement items occurred. For example, an issuer stated in their MD&A that revenues, royalties, and production costs in the current period are in line with expectations. Staff are of the view that this disclosure was not sufficient as readers were not able to understand how management was measuring performance and why variances were reasonable to management. In other instances, we've seen issuers provide explanations that don't appear to be consistent with their other disclosure. It's important that issuers provide a discussion that properly explains the factors that have led to variances in their results, as this will help readers understand general trends and seasonality in the issuer's business. Next, future plans, trends, and risks. In order to help investors anticipate what is potentially in store for an issuer, management needs to outline their future plans for the business. They also need to disclose the trends and risks of the issuer's business and industry and their possible impact on the issuer's future results and cash flow. Staff have noted that many issuers do not provide sufficient information in the MD&A regarding significant projects that are in the planning stage or are currently being undertaken. Form 51-102-F1 requires that issuers with such projects describe the project, their plan for the project and their status relative to the plan, the expected costs, and the anticipated timeline to completion. However, many issuers only state that there is a project and provide very few details about timing and cost. Conversely, staff have noted that issuers are sometimes overly optimistic regarding the expected timing and cost to complete a project, given an issuer's current circumstances. As much as management wants to be positive about a project, it's important to provide balanced disclosure to ensure that information is not misleading to investors. It's crucial that issuers provide sufficient and realistic information about the timing and cost of significant projects. This information will help investors understand how much financing is needed and when the issuer can expect cash flows from operations to begin. Okay, on to risk factors. In our reviews, we frequently note that risk disclosure is boilerplate and not specific to the issuer. Boilerplate risk disclosure is not useful to investors because it overloads the MD&A with irrelevant facts that may obscure information that is actually significant to an issuer. Instead, issuers should provide detailed and comprehensive disclosure of material entity-specific risk factors and explain how they may realistically impact future results. I'm going to briefly hand it over to Chelsea so she can provide a bit more information about the disclosure that staff expect to see with regards to general and specific risk factors.
Thanks, Jen. You're definitely right in that we want to see industry and entity-specific risk factors disclosed by issuers in the MD&A. Risk factor disclosure facilitates an investor's understanding of the material risks that the reporting issuer faces and allows investors to compare issuers in similar industries as well as across industries. If an issuer determines that a risk is material, then disclosure of that risk is required. As a reminder, a risk is considered material if it is likely to influence a reasonable investor's decision to purchase, hold, or sell securities of the issuer. While we want issuer-specific disclosure, there are some risks that could be general in nature or relevant to several issuers based on their industry, size, or location of operations. For these types of general risks, it is important to remember that another purpose of risk disclosure is to allow readers to distinguish issuers from one another within the same industry and across industries in terms of the level of exposure, the level of preparedness, and the impact that the risk could have on the issuer. An example of general risks that could be applicable to several different issuers is risks associated with cybersecurity. The risk of lost revenue due to disruption of activities, as well as increased chances of litigation, fines, and liabilities for failure to comply with privacy and information securities laws, are just some of the cyber-related risks that all types of issuers could be subject to. Higher insurance premiums and reputational harm affecting customer and investor confidence are other examples of cyber-related risks that could be material to issuers in any industry. While there are many general risks related to cybersecurity, there are also industry-specific risks that issuers should consider as well. These include operational delays or outages, disruptions to supply chains, or customers and the loss of data or devaluation of intellectual property. There are even issuer-specific risks, such as particular geopolitical vulnerabilities due to the location of the issuer's operations. Staff have additional guidance on the disclosure of cybersecurity risks in CSA Multilateral Staff Notice 51347, Disclosure of Cybersecurity Risks and Incidents. While this staff notice is from 2017, we wanted to bring it to your attention, as staff's guidance and expectations for cyber-related risk factor disclosure is still relevant. With growing cybersecurity-related risks, staff plan to monitor these disclosures as part of our continuous disclosure reviews. The existence of general, industry, and issuer-specific risks does not just exist for cybersecurity. The same could be said for climate-related risks as well. The last point that I want to make about risk disclosures in the MD&A before I pass it back to Jen is that risk disclosures are also required when forward-looking information is presented. We noted this practice tip in our corporate finance report, and I wanted to reiterate it here today because later on in the presentation, I'm going to talk about promotional disclosure and forward-looking information in more detail. When forward-looking information is presented in a voluntary or required disclosure document, it's important to include the material risk factors that could cause actual results to differ materially from the forward-looking information. While we understand that it can be difficult to predict the factors that could cause actual results to materially differ from expectations, it is vital that users identify the most likely and serious risks that could impact forward-looking information, as this is essential for investors to understand the forward-looking statements that are being made by the issuer. Back to you, Jen, to finish up the discussion on the MD&A.
Thanks, Chelsea. The last topic I'm going to discuss regarding the MD&A is financial condition disclosures. At all times, but especially when issuers are experiencing financial difficulties, it's vital that issuers describe their financial condition in the MD&A. A good analysis of an issuer's liquidity and capital resources will provide investors with a good understanding of the financial health of the business. In addressing liquidity in the MD&A, we often see issuers reproduce their cash flow statement and provide very little detail about the issuer's specific current and future cash requirements and how they will be funded, disclose a working capital deficiency, but fail to explain how they plan to remedy the deficiency, inadequately disclose significant risks of breaching covenants, and list unrealistic sources of financing given their current circumstances. This type of disclosure doesn't provide investors with useful information about an issuer's cash requirements or explain how they are realistically going to be financed. Instead, issuers should provide a thorough analysis of their ability to generate sufficient cash to fund operations, meet obligations as they come due, and finance planned growth and future development. Staff will expect an issuer's analysis to consider historic cash flow from operating activities, expected changes in cash flow going forward, required or planned capital expenditures, and reasonable sources of funding that are available. To summarize, staff encourage issuers to generally increase the level of detail provided in their MD&A. Specifically, issuers need to describe the issuer's new projects or lines of business so readers can understand results, explain why variances in financial statement items occurred, outline the expected costs and timeline to complete significant projects, provide entity-specific risk factor disclosure, and identify the issuer's cash requirements and how they are going to be funded. Disclosure should focus on information that is material or might change an investor's decision and give equal prominence to both positive and negative news. Doing all of these things will improve the information that investors receive, allowing them to make more informed investment decisions. Okay, I'm going to hand it back to Chelsea to introduce the next topic.
Thanks, Jen. That is a great summary of the common deficiencies we note in the MD&A filings. Before we get into other key disclosures, here's the first CPD learning code. The first code word is disclosure. As Nicole mentioned, you'll need to enter this word in the survey at the end of the presentation to get your CPD credit. We're going to leave this code up for a few minutes while I introduce the next topic. The next topic on the agenda is other key disclosure documents and some reoccurring issues that we're seeing with these documents. As Nicole mentioned earlier, it's very important to ensure that all continuous disclosure documents a reporting issuer has filed are complete and up to date. Jen, I'll pass it over to you to get us started.
Thanks, Chelsea. I'll start with a discussion about certificates. Reporting issuers are required under National Instrument 52109 to have their CEO and CFO certify their annual and interim filings. The objective of this requirement is to generally improve the quality, reliability, and transparency of an issuer's filings. Filers should note that there are different certificates for venture and non-venture issuers and annual and interim filings. Further, there are certificates that are required for certain circumstances such as refilings, filings following an IPO, becoming a non-venture issuer, and in connection with filing a voluntary annual information form. There are instances where we have seen the wrong certificate being filed, and issuers should ensure they are familiar with the different types and ensure that the appropriate certificate is filed along with the issuer's related documents. It is also worth noting that staff have identified instances where issuers have modified the language of a filed certificate. For example, we often see venture issuers remove the note to reader required in the venture issuer basic certificate. However, altering the wording is not permitted, and issuers must file certificates in the prescribed form. Staff may require refiling of certificates if we identify that this has occurred. Further, we have identified discrepancies in dating resulting in certificates that do not adequately certify the related documents. For example, a certificate dated and filed prior to filing the financial statements, MD&A, and annual information form will not certify those documents. Certificates must be filed on or after the date the related documents that are being certified are filed, and certificates must be dated the day they are filed. If staff identify this problem, an issuer will be asked to refile the certificates. Lastly, staff have seen instances where issuers have failed to conclude on the effectiveness of internal controls over financial reporting, or ICFR, and disclosure controls and procedures, or DCMP, in their annual MD&A, even though they filed a certificate that indicated that the conclusion was provided. Conversely, staff have identified circumstances where issuers have disclosed in the MD&A that the CEO and CFO have certified the design of ICFR and DCMP, but the certificates that were filed did not address the design of ICFR and DCMP. To avoid these issues, before filing the certificates, issuers should ensure that the correct form is being used, the wording has not been modified, certificates are dated appropriately and filed at the same time or after the documents that they are certifying are filed, and ensure that declarations made in the MD&A regarding certificates are accurate. Moving on to material contracts. As outlined in section 12.2 of National Instrument 51-102, issuers are required to file material contracts unless they are considered to be entered into in the ordinary course of business. Generally, contracts will be considered material when they involve a change to an issuer's capital or corporate structure, significantly impact an issuer's financial results, represent a substantial change to an issuer's operations, describe a significant acquisition, or impact a credit agreement. An issuer will need to exercise judgment to determine whether a contract is material. They will also need to determine if a material contract has been entered into in the ordinary course of business based on the context of the business and industry. It should be noted, however, there are certain contracts that may be entered into in the ordinary course of business that are required to be filed due to the significant impact they have on an issuer, such as a continuing contract to sell the majority of an issuer's products or services. It's important that issuers file material contracts so investors can understand the impact a contract will have on the business and operations of the issuer. Yet staff have identified circumstances where material terms needed to understand a contract have been omitted. For example, in some cases, issuers have redacted covenants in a filed credit agreement. Omission of material terms is generally not permitted, and redacting information about covenants is specifically prohibited. In circumstances where we see this type of information being omitted, staff will require the contract to be filed without the redaction. Generally, material contracts should be filed as soon as possible, but they are required to be filed no later than the time the reporting issuer files a material change report, if entering into the contract constitutes a material change, and no later than the date the AIF is filed, if the contract was adopted before the date of the AIF. If the issuer is not required to file an AIF, the material contract must be filed within 120 days after the end of the issuer's completed year. This next slide shows a few examples of common types of contracts that may be entered into by an issuer. A credit agreement or other material financing agreement would generally be considered to be material if the reporting issuer's business is substantially dependent on the agreement. The same is true for franchise, license, or management agreements. Whereas a standard employment contract that is entered into in the ordinary course of business would generally not be considered a material contract and therefore not required to be filed. Chelsea is now going to take you through some of the other key disclosure documents where we see issues on a regular basis.
Thanks, Jen. The first document that I'm going to discuss is material change reports. When a material change occurs, an issuer must immediately issue and file a news release authorized by an executive officer disclosing the nature and substance of the change. The material change report is required to be filed as soon as possible and in any event within 10 days of the date on which the change occurred. The issue we most often see is that an event which appears to be a material change has not been identified as such, and therefore the material change report is not filed. In National Instrument 51102, a material change is defined as a change in business, operations, or capital of a reporting issuer that would be reasonably expected to have a significant event on the market price or value of any of the securities of the reporting issuer, or a decision to implement such a change that's made by the board of directors or other persons acting in a similar capacity. It can also be a decision made by senior management who believe that confirmation of that decision by the board of directors is probable. Example of changes that require reporting, if material, may include breaches of financial covenants under a credit facility, or significant disruptions to a reporting issuer's workforce or operations. Transaction-specific examples that could be considered material changes include significant acquisitions or dispositions, related party transactions under Multilateral Instrument 61101, or entering into an agreement to complete a reverse takeover. A good resource for examples of potentially material information is included in Section 4.3 of National Policy 51201, Disclosure Standards. While the list is not exhaustive and is not a substitute for companies exercising their own judgments in making materiality determinations, it does include examples of changes in corporate structure, capital structure, and credit arrangements, as well as financial results and operations, including acquisitions and dispositions, that could be considered material and would require a material change report to be filed. When a material change report is filed, it should describe the significant facts relating to the material change, provide information about the time and resources required for the change in business, as well as any barriers and obligations that are involved in realizing the change. The disclosure should be factual and balanced. Unfavorable news must be disclosed just as promptly and completely as favorable news. Enough detail should be provided in the material change report so that investors can understand the substance and importance of the change. Staff also recommend avoiding unnecessary details, exaggerated reports, or promotional commentary. To continue with the topic of changes in an issuer's business, we often see companies enter into transactions that require special documents to be filed. However, because these documents are not routine, they're often missed by reporting issuers. I'm going to highlight the circumstances which require these additional documents to be filed and deadlines for filing as a reminder. The change in corporate structure notice is required to be filed when an issuer is party to a transaction that results in the issuer becoming a reporting issuer other than by filing a prospectus. So, for example, when a private company completes a reverse takeover and becomes a reporting issuer. Other transactions that require a change in corporate structure to be filed include if an issuer is already a reporting issuer and they enter into a transaction which results in them ceasing to be a reporting issuer, or changes their name or financial year end. When filing the notice, the issuer needs to include the names of the parties to the transaction, as well as a description of the transaction and the effective date. The disclosure should also include the name of each party that ceased to be a reporting issuer, if there are any, as well as the names of the continuing entities. The change in corporate structure notice is required to be filed as soon as possible and no later than the deadline for the first filing required under National Instrument 51-102 following the transaction. As previously mentioned, another change that requires a notice to be filed is a change in year end. Changes in year end could be the result of a transaction or a decision by management and the board of directors to change the financial year end. If the year end is changed by more than 14 days, the issuer is required to file a notice that states that, and the reporting issuer has decided to change their year end, including their reasons for the change, as well as the old and new financial year ends. The length and ending date of the periods, including the comparative periods of each interim and annual financial report, must also be included, as well as the filing deadlines for the transition year. If the change in year end is a result of a reverse takeover transaction that occurred and the year end remains the same or was changed to be the same as the reverse takeover acquirer, then the change in year end notice is not required to be filed. Another change that results in the requirement to file documents is a change of auditor. Usually, a change in auditor requires 3 documents to be filed. The first is the reporting issuer's change of auditor notice, which is required to include the date of termination or resignation and details about the change. Specifically, the notice must state whether the predecessor auditor resigned on their own initiative or at the request of the reporting issuer, was removed or proposed to shareholders to be removed during the term of appointment, or was not reappointed or proposed for reappointment. The notice must also state whether the termination or resignation of the predecessor auditor and any appointment of a successor auditor were considered or approved by the audit committee, and whether the predecessor's audit report on any of the financial statements expressed a modified opinion. If a modified opinion was expressed on any of the financial statements relating to the relevant period, a description of each modification must be included in the notice. The notice also requires information on reportable events. There are 3 categories of reportable events, which include disagreements, consultations, and unresolved issues. Our reviews have identified instances of changes in auditor documents failing to state that there are no reportable events. Usually, when staff have inquired, it has resulted in the reporting issuer having to refile the change in auditor notice to include it. In addition to the notice, the other 2 documents that are required to be filed with securities regulators are the letters from the predecessor auditor and the successor auditor. Both documents are required to be filed within 14 days after the termination or resignation of the predecessor and the appointment of the successor auditor. I'll pass it now back to Jen to finish up with the filing requirements for audit committee, corporate governance, and executive compensation disclosures.
Thanks, Chelsea. Corporate governance disclosures are required to be filed on an annual basis. If the issuer files an information circular, the corporate governance disclosures must be included there. However, when the issuer does not send an information circular, the disclosures must be included in the annual information form or annual MD&A if the issuer is not required to file an annual information form. The purpose of corporate governance disclosure is to provide investors with transparent information about an issuer's management, including whether officers and directors are independent or not. The most common issue identified by staff regarding corporate governance disclosure is that it hasn't been filed. As such, issuers should take note of the filing requirements previously discussed. When it is filed, staff often find that the disclosures are not complete. For example, issuers often don't provide disclosure regarding their assessment of the effectiveness of the board, its committees, and its individual directors. More seriously, when comments are raised regarding corporate governance disclosures, it's sometimes revealed that there are directors that have been incorrectly identified as being independent. Further, the reason they are not independent has not been disclosed. This is concerning, as not being aware of the independence issue, investors will not be able to assess its impact on the issuer. In these circumstances, staff will likely require that the disclosure be amended and refiled. To avoid this situation, issuers should ensure that any material relationship that could reasonably interfere with the exercise of independent judgment be identified and clearly disclosed. The purpose of audit committee requirements and disclosure is to encourage issuers to establish and maintain strong and effective audit committees to enhance the quality of financial disclosure. Some of the key responsibilities of the audit committee are to recommend the external auditor and oversee their work, pre-approve non-audit services provided by the external auditor, and review the issuer's financial statements, MD&A, and related news releases before they are publicly disclosed. Audit committees must be composed of a minimum of 3 members. With regards to non-venture issuers, it's required that all audit committee members be independent. And with regards to venture issuers, a majority of the audit committee members must not be executive officers, employees, or control persons of the issuer or an affiliate of the issuer. On occasion, staff find that the composition of the audit committee doesn't meet these requirements, and in these circumstances, issuers identified in default of the requirement will be noted in default on the reporting issuers list until the default is corrected. Audit committee disclosures are also required to be filed on an annual basis. For venture issuers, these disclosures are included in the same document as the corporate governance disclosures. Non-venture issuers, on the other hand, are required to include audit committee disclosures in their annual information form, and if they are required to file an information circular, a cross-reference to the sections in the issuer's AIF that contain the audit committee disclosures must be provided. Executive compensation disclosures are required annually. If the issuer files an information circular, the executive compensation disclosures must be included there. However, when the issuer does not send an information circular, the disclosures must be included in the annual information form or as a standalone document if the issuer is not required to file an annual information form. Venture and non-venture issuers must file executive compensation disclosure no later than 180 and 140 days respectively after the end of the issuer's most recently completed financial year. That concludes the specific continuous disclosure documents that we want to discuss today. I'll now pass it over to Chelsea.
Thanks, Jen. The next part of the presentation is titled Hot Topics and includes a few current issues that issuers should carefully consider when drafting their disclosures. As I mentioned earlier, a theme we continue to see this year is forward-looking information and overly promotional disclosures. As a reminder, forward-looking information, or FLI, is disclosure regarding possible events, conditions, or financial performance that is based on assumptions about future economic conditions and courses of action. It also includes future-oriented financial information with respect to future financial performance, financial position, or cash flows that is presented as a forecast or projection. There are disclosure requirements for all forward-looking statements disclosed by reporting issuers other than ones in oral statements. This means that disclosure requirements apply to forward-looking information included in required filings, such as MD&A and annual information forms, as well as voluntarily filed documents, such as corporate presentations, sustainability reports, and investor materials. In addition to the issue that I previously mentioned about not including risk factors that could cause forward-looking information to materially differ from what is forecast, staff is also seeing issues where forward-looking information disclosures may be considered overly promotional. This slide illustrates an example of overly promotional forward-looking information and is similar to what staff have seen presented in corporate presentations. The reason that this is considered overly promotional is because it lacks details about the potential growth to be achieved. The disclosure does not include the material factors and assumptions that were used in developing the forward-looking information, which would include how the 300 million global market was derived, as well as how management calculated the 38% market share or projected future sales of 114 million. Situations where we have seen forward-looking information that could be considered overly promotional is when it's related to proposed or recently completed acquisitions, development projects, or climate-related goals. You may have heard of overly promotional climate-related forward-looking information being referred to as greenwashing. Issuers disclosing environmental, social, and governance performance where claims are unsubstantiated, overly broad, or untrue about the sustainability of operations, products, or services are examples of greenwashing. As a best practice, staff suggests that if issuers are disclosing plans for being net zero, carbon neutral, or other similar statements, we would expect there to be a reasonable basis to support those statements, as well as sufficient detail provided so investors can understand how the issuer anticipates achieving that goal. All statements must be factual, balanced, and substantiated. The amount of detail that should be disclosed will depend on the aspect of the issuer's ESG performance that includes forward-looking statements. For example, if an issuer discloses its goal to be carbon neutral by 2030, the disclosure should be supplemented with information regarding their current status of emissions, as well as the detailed plan to achieve this goal, and how they plan to reach the goal and anticipated milestones. It's important to remember that forward-looking statements must not be disclosed unless the issuer has a reasonable basis to provide the disclosure. If the disclosure of forward-looking information does not appear to have a reasonable basis or supplementary information is not provided, staff may raise comments asking the issuer to support the statements. If sufficient support is not provided, staff may ask the issuer to remove or withdraw the forward-looking statements. In addition to only disclosing FLI if the issuer has a reasonable basis to do so, and including the material factors and assumptions used in determining that FLI, there are some other best practices that can help issuers successfully disclose forward-looking information without it being considered overly promotional or unsupported. Issuers are required to ensure that statements made regarding future events are factual, balanced, and substantiated. For example, issuers who make claims about their relationships with organizations and the resulting social impact of those relationships. For this disclosure to not be considered misleading, details about the organization's activities, the particular aspects of sustainability that are being addressed through the relationship, and the manner in which these aspects are measured and assessed should be included. Additionally, there are requirements for issuers to include updates to previously disclosed forward-looking information in their MD&A. One of the requirements is for issuers to update the MD&A for events and circumstances that have occurred during the period that are reasonably likely to cause actual results to differ materially from the forward-looking information that was previously disclosed to the public for a period that's not yet complete. It's important for issuers to provide updates for both positive and negative events and circumstances. Additionally, if an issuer decides that there are events or circumstances that have become apparent that would cause the forward-looking information to no longer be valid, this decision must be disclosed in the MD&A. The disclosure should include a discussion of the events and circumstances that led the issuer to make the decision to withdraw the forward-looking information, and include a discussion of the underlying assumptions that are no longer valid. The next hot topic we're going to cover is a sufficiency of proceeds issue that we've been seeing in prospectuses and other offering documents. Over to you, Roger.
Thanks, Chelsea. We wanted to raise sufficiency of proceeds as it's an area that can result in delays in the prospectus process. Where staff review a prospectus filing and have concerns over the financial condition, short-term liquidity or sufficiency of proceeds of the company will usually raise questions and may ask for support to assist in our analysis. This applies to all prospectuses. However, more recently it has popped up during our review of base shelf prospectuses. Another area where we've also had these concerns is regarding use of the listed issuer financing exemption, which was adopted by all securities regulatory authorities in Canada in November 2022. This is a prospectus exempt offering, which allows issuers to file a Form 45106 F19 offering document rather than prospectus offering documents. This exemption is not available if a reporting issuer lacks sufficient funds to continue operations and achieve its business objectives for a period of 12 months following the distribution. The liquidity analysis for this would be similar to the analysis that we perform for a prospectus offering. I'll run through some key provisions in the regulations, go through some sufficiency of proceeds examples, and what we consider short-term liquidity, plus considerations in the analysis and support material that we may ask for, which usually includes a cash flow forecast and some possible ways to address the sufficiency of proceeds concerns. Section 120 of the Securities Act outlines when the executive director can issue or refuse the issuance of a receipt for a prospectus. I've included on this slide some of the areas of focus that are considered when determining whether or not a receipt for a prospectus is issued, one of which is sufficiency of proceeds consideration. During our prospectus reviews, if there are significant concerns that the anticipated proceeds to be received from the prospectus and the other resources available to the issuer would not be sufficient to accomplish the stated purpose of the prospectus, we may refuse final receipt of the prospectus. The purpose of the sufficiency of proceeds receipt refusal provision is to protect the integrity of the capital markets, which would be harmed if an issuer ceased operations on account of insufficient funds shortly after completing a public securities offering. Possible scenarios where we may consider the anticipated proceeds from a prospectus offering to be insufficient include when proceeds being raised for a specific purpose under the prospectus are not sufficient to meet the stated purpose of the prospectus and address short-term liquidity requirements. Next, if the prospectus is a best efforts offering with no minimum subscription, or it has a minimum subscription, and in either case, it's not enough to address the company's short-term liquidity requirements. And finally, if the prospectus is a base shelf prospectus offering, where proceeds can be raised in increments over a 25-month period, but staff have determined that the company does not have sufficient cash and other resources to meet its short-term liquidity requirements. After going through those examples, you may be wondering, what do we mean by short-term liquidity? Short-term liquidity requirements are not defined under securities legislation, as it varies depending on the circumstances of each issuer. When assessing short-term liquidity, we consider the type of issuer. For example, an issuer that is still developing its business will have different requirements than an issuer with commercial operations. When assessing whether the anticipated proceeds raised under a prospectus offering is sufficient to meet the issuer's short-term liquidity requirements, the period of time assessed in our analysis will depend on which category in this chart that the issuer falls into. For example, if for a mining company in the exploration stage, we'll assess whether the net proceeds from the prospectus offering and other resources available to the issuer are enough to reach completion of the next phase of the issuer's project. Whereas if the issuer has active operations, we'll conduct the same analysis, but for a period usually over 12 months. I also want to add that regardless of the type of issuer, if the prospectus is in the form of a base shelf prospectus, generally we'll conduct a liquidity assessment over a period of 12 months, similar to the period in a going concern assessments. When we're conducting our sufficiency of proceeds analysis, we'll look at the full picture in aggregate. We'll consider any going concern risks, working capital deficiencies, including debt obligations in the near term, any covenants that may have been breached or are close to being breached that could have an impact on the available financing, negative cash flow from operations, net losses, insufficient cash and other resources to meet non-discretionary capital or project costs, etc., etc. I wanted to also highlight that when we're conducting this analysis, we only consider committed financing. We don't consider speculative financing. As I indicated at the beginning of the session, if staff have sufficiency of proceeds concerns, will usually ask for a detailed monthly cash flow forecast to demonstrate that the issuer has sufficient cash and other resources to support its short-term liquidity requirements. The cash flow forecast should project the issuer's significant sources and uses of cash for the period of time that the issuer has represented that it can continue operations, and also address the issuer's working capital deficit if one exists. The forecast should also include material factors and assumptions to support management's estimates. At times, we'll receive cash flow forecasts that don't provide management's assumptions in sufficient detail. For example, we're looking for sufficient details around some of the bigger inputs, such as working capital, revenue streams, capital expenditures, other expenses, and additional sources of financing. For working capital, this should tie back to the issuer's most recent financial statements. For revenue streams, we're looking for sufficient detail to understand how tangible the revenue streams are. For example, what amount of sales is derived from signed customer contracts, ongoing discussions, or speculation? For capital expenditures or project costs, we're looking for sufficient detail to understand what the issuer thinks they need to spend to meet its business objectives and milestones. We're trying to understand what amount of the costs are considered discretionary versus non-discretionary. It would also be useful to understand what impact the discretionary costs have on the cash flow projections. For example, if the issuer has discretion over those costs, we would assume that if they didn't spend that money, it would seem reasonable that it would result in a decrease in the sales and associated cost projections. We also need enough information to assess whether the other expenditures, such as cost of goods sold, general and administrative costs, and gross margin percentage, are reasonable. Unless the issuer provides otherwise, we usually assess whether this is consistent with the company's historical financial performance and update our expectations based on the company's disclosures. It would also be helpful to understand what other sources of financing are available to the issuer. For example, if the issuer has an existing credit facility, it would be helpful to understand what amount of the credit facility is available for the issuer to use. This would include trying to get an understanding of the impact of the cash flow projections and working capital on any financial debt covenants. It might appear that the issuer has room between the authorized borrowing limit and the amount of debt outstanding. However, this might not be the case if a draw in the facility may result in a debt covenant breach. If at the end of our review, and based on the cash flow forecast, it shows that the issuer will not have sufficient proceeds to meet the short-term liquidity requirements, we may, one, where no minimum offering amount was included in the prospectus, require a sufficient minimum to be provided that is enough to meet the issuer's short-term liquidity requirements. Two, where a minimum was provided in the prospectus, but we determined that it was not enough to address the issuer's short-term liquidity requirements, we may require the issuer to increase the minimum to an amount to address any cash flow deficiency shown in the cash flow forecasts. To address any cash flow deficiencies, sometimes issuers will go back and raise additional financing via private placements, debt financing, a backstop such as a standby commitment, rather than increase the minimum offering amount in the prospectus. We are usually okay with this as long as it addresses any cash flow shortfall. Finally, if the prospectus is a base shelf prospectus and the 12-month forecast shows a working capital deficiency, staff will question the appropriateness of using a base shelf prospectus. In this case, we may require the issuer to withdraw the base shelf prospectus and come back in with a short form prospectus using Form 44-101 and include a sufficient minimum offering amount. I hope that this discussion has clarified what staff consider when assessing sufficiency of proceeds. I'm now going to pass it back over to Nicole.
Thank you, Roger. Before I start, here's the second CPD learning code for you. The second code word is CEDAR plus. I previously mentioned the consequences of not filing continuous disclosure documents and being noted in default as securities legislation or cease traded. Subsequent to being cease traded, we often receive questions regarding the revocation of a failure to file cease trade order. So I'm going to spend the next couple of minutes talking about the application process and things to consider before submitting an application for the full revocation of a failure to file cease trade order. Before we get into the application process, I want to take a step back and explain what a cease trade order is. A cease trade order is defined as an order under a provision of Canadian securities legislation that one or more persons or companies must not trade in securities of a reporting issuer, whether directly or indirectly. In other words, a cease trade order is a decision issued by the ASC or other CSA jurisdictions against reporting issuers for failing to comply with securities legislation. In most cases, cease trade orders are issued for the failure to file required continuous disclosure documents within the prescribed time periods. But cease trade orders are also issued when the continuous disclosure documents filed do not meet disclosure requirements or as a result of an enforcement action that involves an investigation of potential wrongdoing. While subject to a cease trade order, a person or company generally must not purchase or trade in a security of the reporting issuer, except in accordance with any conditions of the order, including any variation or partial revocation order, until a full revocation of the cease trade order has been issued. The application to obtain a full revocation of a failure to file cease trade order depends on how long the cease trade order has been in place. If it has been 90 days or less, no application is required. The review process by the principal regulator for revocation of the cease trade order is initiated when the required continuous disclosure documents are filed on SEDAR+. On the other hand, if it has been more than 90 days, an application for a full revocation of a cease trade order must be submitted to the principal regulator. In instances where the reporting issuer reports in both Alberta and Ontario, a dual application must be submitted to both regulators. Prior to submitting an application for a full revocation of a cease trade order, there are certain things a reporting issuer should take into consideration. Start by preparing all outstanding continuous disclosure documents. Each situation is unique, but we can generally consider that disclosure for periods within the most recent 3 financial years for a non-venture issuer or the most recent 2 financial years for a venture issuer is sufficient. We also generally do not consider the time and costs required to prepare disclosure to be a compelling factor in the determination of the disclosure to be provided in connection with an application to revoke a failure to file cease trade order. Once all the outstanding continuous disclosure documents have been prepared, they should be filed on SEDAR+. Frequently, there is required continuous disclosure documents that are missing when the application is received. As discussed earlier in today's session, there are a number of required continuous disclosure documents, and each has specified filing deadlines. So it is important that issuers are considering all outstanding continuous disclosure documents that are relevant to them. Complete a personal information form for each current and incoming director, executive officer, and promoter of the issuer. The personal information form should be in a form as set out in Appendix A of National Instrument 41-101, the General Prospectus Requirements, or Form 51-105 F3A for issuers quoted in the U.S. over-the-counter markets. Confirm that the issuer's SEDAR+ and SETI profiles are up to date. Prepare a draft news release and material change report. When the full revocation order is issued, the news release and material change report will be filed to announce the revocation of the cease trade order. If the reporting issuer's annual meeting requirements have not been complied with, provide an undertaking address to the Executive Director of the Alberta Securities Commission to hold an annual meeting within 3 months after the date of the full revocation order. The undertaking will be filed when the full revocation order is issued. Lastly, pay all outstanding fees to each jurisdiction in which the issuer reports. The revocation order will not be issued until all fees have been paid to each relevant CSA regulator. So, in summary, prior to submitting an application for a full revocation of a cease trade order that has been in place for greater than 90 days, a reporting issuer should consider these 7 items. Once you are ready to submit an application, the application and associated fees are to be submitted through SEDAR+. A complete list of the materials required to be filed with an application for a full revocation of a failure to file cease trade order can be found in Section 33 of National Policy 11-207. I hope that this will help you prepare before submitting an application. Now, Tim will provide an update on the recent regulatory developments.
Good morning. I'd like to provide a quick update on some key regulatory developments in corporate finance over the past year. I'm going to speak briefly on our climate-related disclosure and diversity disclosure projects. I'll also touch on the life exemption we rolled out a little over a year ago. And finally, I'll provide an update on our ongoing work on WCSIs, electronic access to disclosure, and streamlining of the principal continuous disclosure documents. I'll begin with climate-related disclosure. We at the ASC have co-led this work within the CSA since 2016. In 2022, we published Proposed National Instrument 51-107. That instrument provided for a disclosure regime that was based on some of the recommendations of the Task Force on Climate-Related Financial Disclosures, or TCFD. Since our proposal was published, there have been a number of significant developments. These include regulatory proposals such as that by the SEC, and most notably, in June of last year, the CSA welcomed the publication by the International Sustainability Standards Board, or ISSB, of its first two sustainability standards. One of these, S1, is general in scope, and the other, S2, is focused on climate-related disclosure. At around the same time, the Canadian Sustainability Standards Board also became operational. The CSSB is currently working on local adaptations of the ISSB standards to be implemented in Canada. We at the CSA are following these developments closely. We anticipate that the next iteration of our proposed rule will be heavily influenced by the standards adopted by the ISSB and CSSB, with modifications that reflect the needs and realities of the Canadian market and its participants. Timing will depend to some extent on the progress made by the CSSB, as well as the rulemaking process among the members of the CSA. We are certainly mindful that any rule we adopt will need to provide issuers with adequate time to prepare for and adapt to the new requirements. It's also important, we think, to note that the adoption of standards by the ISSB and CSSB does not create legal obligations for issuers. Securities legislation will not require reporting issuers in Canada to provide disclosure based on these standards until our rulemaking process is complete. Next, I'd like to touch on proposed diversity-related amendments to the corporate governance disclosure requirements in Form 58-101F1 and the governance guidelines in National Policy 58-201. This is a very complex project that ASC staff are also co-leading. In April of last year, we published for comment proposed amendments to the disclosure requirements pertaining to the director nomination process, board renewal, and diversity. CSA members were aligned on the importance of disclosure of broader diversity, but we had a divergence of views on how to achieve this. Therefore, we offered two alternatives. Both approaches are intended to provide investors with enhanced, decision-useful information to assist them with their investment and voting decisions. In addition, we also proposed changes to the corporate governance guidelines that would enhance the existing guidelines relating to the director nomination process, as well as introduce new guidelines for board renewal and diversity. Again, there was a divergence of views on approach, and therefore two alternative approaches were proposed. We're currently reviewing the feedback that was submitted in response to that publication. Next, I'd like to move on to the listed issuer financing exemption, or life exemption, which was adopted across the country in late 2022 in order to provide issuers with a more efficient method of raising capital. This exemption allows non-investment fund issuers, which are listed on a Canadian exchange and compliant with their continuous disclosure obligations, to raise up to a maximum of $10 million in a 12-month period by distributing securities to the general public. There are a number of conditions and limitations on use of the exemption and the specific amount that can be raised by any given issuer, but significantly, the securities issued are generally not subject to resale restrictions. The life exemption relies on the issuer's continuous disclosure record, as supplemented with a short offering document, which is not subject to review prior to its use in an offering. Last June, the CSA issued Staff Notice 45-330, which sort of acts as an FAQ document with respect to the life exemption. As Roger mentioned earlier, the most prevalent issue we've seen relates to issuers' compliance with the available funds requirement. Therefore, we encourage issuers to review the guidance in the staff notice, as well as in our most recent corporate finance disclosure report for further information. On to the well-known seasoned issuer or WIXI regime. Like the life exemption and the other projects I'll be discussing momentarily, this was a product of the CSA's ongoing regulatory burden reduction initiative. In response to commenter feedback, we began work on rule amendments that would permit a category of larger and well-established issuers to proceed directly to the filing of a final base shelf prospectus, with no requirement to file a preliminary prospectus and obtain a receipt for the final prospectus promptly thereafter. All of this would be done without the need for the usual regulatory review. In early 2022, each CSA jurisdiction issued a blanket order creating such a regime with certain modifications due to the need for legislative amendments to implement the permanent regime. But the blanket order was intended to serve as a trial of the system on a temporary basis. This initiative has been very well received. Virtually all of the Alberta shelf issuers that are eligible to use the system have opted to do so. Last September, the CSA published proposed amendments to implement a permanent WIXI regime. The amendments include certain refinements on the blanket order, such as automatic receipting and the ability to offer securities under a WIXI prospectus for up to 2 years, or for up to 3 years, rather. The current standard, or the current limit under our shelf regime is a shelf life of 2 years. We anticipate the final amendments in this regard will be in place later this year. The CSA has also been working on amendments to update the way in which disclosure is provided to investors. In 2022, we published a proposal to implement an electronic access model for prospectuses, as well as certain continuous disclosure for non-investment fund issuers. Under the proposed model, providing access to the documents and alerting investors that the documents are available would have constituted notional delivery of the documents. Commenter feedback suggested that we hit the mark in terms of access to prospectuses, so final amendments in that regard were published just last week. Those will become effective in mid-April. However, the same feedback process suggested that more work was needed in order to develop a successful access model for continuous disclosure documents. That work is continuing, and we are targeting publication of a modified proposal for comment on the continuous disclosure side later this year. I'd like to finish with a quick update regarding the status of our project to combine the annual financial statements, MD&A, and AIF into an annual disclosure statement, and the interim financial statements and MD&A into an interim disclosure statement. The new forms that we proposed will also streamline the disclosure requirements to some extent and reduce or eliminate a few instances of overlap and duplication that exist across the current forms. We published proposed amendments back in 2021. They were generally well received, and we do not anticipate significant changes to the final amendments. However, these amendments were intended to be implemented in conjunction with electronic delivery or access to these materials, as the book that issuers will be providing to shareholders will include the AIF, which is not required to be delivered at the present time. We also wanted to minimize disruption to issuers' annual disclosure process resulting from the need to separately adapt to both the new disclosure forms as well as a new electronic access regime. As a result, we anticipate that the streamlining amendments will be implemented in conjunction with the CD access equals delivery amendments, with adequate time for issuers to transition to the new requirements. With that, I'll hand it on to Denise.
Okay, thanks, Tim. All right, we're going to go into our Q&A session here. And so I'll invite everyone back onto the screen for that. We have a couple questions that, well, actually, while we were waiting, there was some questions that about the slides. And so I answered that in the Q&A, but just for everyone, the slides will be available on our website right after the presentation. There's a section for news and publications, and then it has events and reports. So you can go there and get that. And then the full recording should be available in the next couple weeks, and it will be available on our website in the same place. So we have a couple questions that deal with incorporation by reference of risk factors, and whether you can incorporate by reference into the AIF or the MD&A. So I think Chelsea, do you want to take that one?
Yeah, definitely. So the question specifically here is if an entity files an AIF, which does contain significant details of a company's risk factors, can the MD&A simply refer to the AIF instead of duplicating that same information again in the MD&A? So risk factors are actually required to be disclosed in the MD&A. However, if issuer files an AIF, form can refer to the MD&A risk factor disclosure. And so the reason for this is because the AIF is supposed to include general risks relating to the issuer's business, including the economic and political conditions as well as the financial history. The MD&A, on the other hand, is supposed to provide updates on factors that are specific to the financial statements for that period. So that means that we expect the quarterly MD&A to be updated for risks that are specific to the period's capital resources, liquidity issues, and any forward-looking information that may have been disclosed. With that being said, though, we are working to consolidate risk factor disclosures as part of the regulatory burden reduction amendments that Tim had mentioned earlier.
Great, thanks, Chelsea. There was another question about whether MD&A can, whether instead of MD&A, an issuer could file a quarterly summary. Nicole, do you want to, I'm not sure. Nicole, do you want to take that one?
Yeah, so all venture and non-venture issuers are required to file interim and annual MD&As. For venture issuers, when we're talking about their interim MD&A specifically, they do have the option to provide a short discussion of the material information that has occurred in that interim quarter. And that would just be a shorter MD&A.
But you guys haven't seen much of that, I guess.
No, it's not very common.
Okay. All right. Then there is a question on executive compensation. And so if the company has their named executive officers, their NEOs are in the US and they're paying them in US dollars, can they report in the executive compensation section that compensation in US dollars? Jennifer, you want to take that one?
Good question. Companies must report amounts required by the executive compensation form in Canadian dollars or in the same currency that the company uses for its financial statements. If amounts were paid in a different currency, an issuer must disclose the currency exchange rate and describe the methodology used to translate the compensation into Canadian dollars or the currency that the company uses in its financial statements.
Okay, thanks, Jennifer. Okay, so the next question I think is about forward-looking information and withdrawing forward-looking information. So what is the required timing for withdrawing FLI, the next reporting period, or on immediately realizing the FLI will not be met? I think, Chelsea, were you going to take that one?
Yeah. So an issuer is required to disclose in the MD&A the decision and the events and circumstances that led to the decision to withdraw forward-looking information. And it's supposed to include a discussion of the assumptions that are underlying the FLI that are no longer valid. The only way that the disclosure is not required to be included in the MD&A is if a news release was issued that discloses that information instead. So if that is the case, then the MD&A should refer to the news release, including the date and a statement that it is available on CDAR Plus. And just to clarify, a news release would be required as soon as forward-looking information was determined to be no longer valid, if it was considered a material fact or change that required immediate disclosure per the exchange policies.
Thanks, Chelsea. Okay, there's a question here about to what extent do we anticipate the changes and trends in the CSRD will impact disclosure requirements in Canada and North America? So that I believe is referring to the EU Corporate Sustainability Reporting Directive. It's a good question. I think there was some reporting suggesting that there was like a very significant number of Canadian companies impacted by that. It seems like that probably included non-reporting issuers. So, you know, I don't know that we have can have a good answer for that. You know, it may be if and when we adopt climate related disclosure requirements in Canada, that you know, there'll be some sort of agreement to you know, allow reliance on another jurisdiction's disclosure, but we're still in early days on that. So I don't know if there's anything, Tim, that you want to add on that.
No, I think you know, I think you pretty much covered it, Denise. You know, there are a lot of balls in the air in this area. You know, we've seen proposals, you know, just most recently from Australia. The Americans, the SEC had a proposal that came out a number of months back. Lots and lots of discussion about that, and you know, whether any final rule they might adopt, if any, you know, will be, you know, will resemble the initial rule that they proposed that was fairly draconian. So you know, I think the good news is that there seems to be some divergence around the ISSB and a desire to sort of streamline the requirements in that area. But I don't know that we know exactly how things are going to play out, simply because there are so many you know, so many things at play, and obviously the developments in this area have been very, very rapid. So I'll have to stay tuned on that one, I'm afraid.
Okay. Then there's a question about, are there plans to improve CDAR Plus to make it as easy to use and as fast as the prior CDAR application? Yeah, so CDAR Plus hasn't been quite as smooth as we were hoping, but there are sort of quarterly updates that are being done to that many of them were planned, and some that some additional ones we knew we were going to have to implement after the rollout. So yes, the idea is that it will continue to improve and have fixes made over time. And then, so I think the last question we have here, it says, in respect of a CTO revocation application, would it not be more efficient to deliver the draft outstanding continuous disclosure with the application rather than filing in advance of the application to avoid having to refile all the disclosure if it's deficient in the views of the ASC staff? So Nicole, are you able to take that one?
Yes, so with the CTO applications, we do require that all continuous disclosure documents are brought up to date and filed on CDAR Plus. The reason we do ask this is just we would like to see all disclosure documents at the same time. If we receive an application and they have not all been filed, we do ask the issuer to file everything, and then we will review everything together and then discuss with the issuer any questions that we have.
Okay, thanks, Nicole. So that looks like that's it. Did I miss any questions? I think that we covered everything. If you do have any further questions that come to mind afterwards, our contact information will, I think they're going to put it up on the website right now. So please feel free to reach out to any of us with respect to questions. I guess with that, thank you for joining us. Thank you for attending, and we will sign off and enjoy the rest of your day.